What's the big picture on the currency, and what are the elements that are going to determining how the currency moves through the rest of this year? Pradeep Khanna, Managing Director and Head of Trading at HSBC, is joining us. Pradeep, good afternoon. Thanks for joining us here on Bloomberg Quint. For now, Pradeep, it does look like oil continues to be sort of the biggest variable, which is going to determine whether the rupee takes out 68, moves to a new low, or manages to stay in a band of, say, 66 to 67.
Absolutely. I think at this point in time, oil is clearly the largest driver of sentiment, and I think rightfully so, given that the oil price will immediately add or reduce both current account as well as fiscal deficits. So I think very large bearing for the country, and clearly markets will react to that, pretty much instantaneously.
What's the sense that you're getting from external factors, particularly how the Fed has reacted, what's going on with the dollar globally? What are the external factors that are influencing the direction of the rupee?
Right. I think, broadly we break it down into, the current account deficit, which estimate this year is going to be somewhere in the region of about 2 to 2.5% of GDP. And then financing. Clearly, while we have stable FDI inflows, portfolio flows depend a lot on expectation of return as well as the cost of funding, for investment. So with the Fed hiking and looking like they've got more to go this year, clearly cost of funding is going up, and therefore on a relative basis, it isn't as attractive to put money into not only the Indian market but emerging markets in general. So that I think is the other factor that we really do need to look out for. Apart from the oil price, a lot of how the dollar has traded also recently has been a reaction to market gauging how aggressive the Fed is likely to be this year. And as it increasingly begins to look as if the ECB will delay any action on its part, I think that will again be one of the key drivers that we need to look out for.
Pradeep, exactly. One is, of course, the current account deficit, and yes, the quantum of that is going to depend to a large extent on oil, although not entirely on oil. But on the financing side, we've seen a fair amount of debt outflows. I don't know if that's linked to global, say, EM bond funds seeing slower inflows or outflows, or if it's an India-specific thing. But do you suspect that will continue, and then that could mean a change in the BOP position broadly?
I think it is not entirely an India-specific thing. To a certain extent, emerging markets and relatively higher interest rate emerging markets, and especially where they are oil importers, have seen some amount of outflows. I would suspect, that we should be pretty prepared to see a little bit more outflow over the next 2 to 3 months, because markets are clearly in a period of readjustment, to the realities the way they are being judged. While oil has corrected quite nicely, from just under 80, I would suspect with all the noises coming out of, OPEC, Russia, etc., possibly there is going to be an attempt to try and stabilize somewhere here. Maybe it will take away the potential panic of a what-if scenario. What if oil were to go through 80 and up towards 90 or 100? Maybe that goes away for the time being. But really, are we looking at a substantial move down in the oil price? I don't think there is any confidence in that kind of view either at this point in time. So I think as we adjust to the new realities, and as we keep an eye out for the Fed and other geopolitical developments, I think we should be a bit prepared that we are likely to see slow and steady outflows for the next 2 to 3 months.
So then, Pradeep, even if oil were to stabilize, we are perhaps looking at a lower band for the rupee than was assumed at the start of the year. Because I remember, doing start of the year interviews, and a bunch of people said to me that they expect the appreciation of 2017 to continue in 2018. That seems like an unlikely scenario.
Clearly so, because if one goes back to 2017, the first 3 quarters of that calendar year, current account deficit was substantially lower than where it is today. And also the appetite of foreign portfolio investors was significantly higher. So just the balance of payments position created a large kind of potential for the currency to strengthen. And today it's just the opposite. So I would definitely think that we are not looking at substantial rupee appreciation at this point in time. And the question really comes, has it depreciated enough, or is there a little bit more to go? Myself, I would tend to think that if oil kind of consolidates somewhere around here, that the rupee will continue to trade with a little bit of a weak undertone.
What is your view on how the RBI has viewed the situation, Pradeep? You are seeing the RBI move towards a hawkish direction. So in the medium term, are you anticipating the rupee to get appreciate a little more? Are you seeing the RBI intervene in the currency markets a little more aggressively?
To my mind, I think a little bit of intervention from the RBI has been there, will always be there when we see fairly large, moves in a particular direction, be it up or down. So that I think is a given. And also, as the extent of the move gets larger, the quantum that the RBI may choose to supply to the market also can go up. So I think that is something that we should expect. With regard to tone at monetary policy, I think the reality today is that the bond yields, almost all yields that are there in the market, whether it be where people can access even short-term money, whether it be where 10-year benchmark securities are trading, they are substantially elevated compared to the official policy rates. So I think at this point in time, a move towards a slightly hawkish tone, raising of official policy rates is probably, putting the correct sound bites in place, reassuring investors that the RBI is indeed very focused on inflation. And I think the proper communication needs to come along with that, because given that market rates are already so much higher, I don't think the RBI may want to put in a message that the hike in official rates necessarily warrants substantially higher market rates. It could just be one having led the other.
Pradeep, that's a very interesting point, because I think we were just debating that if at this stage the RBI were to perceive that it's behind the curve, hike rates to sort of adjust that, but it sends a message to the market that it's starting a rate cycle, then the elevation of rates in the market could be even higher. So it's a tough one at this stage, right?
See, that's the point exactly. I think the communication has to be right, because if one goes back and thinks about it fundamentally, the whole objective of raising policy rates is to nudge market rates higher and thereby, make money incrementally a little more expensive and slow down economic activity and curtail inflation. Now, if, the rest of it has already happened except for, the first step, which is the official rates, then, I think clearly messaging from the RBI that A, they are hiking, B, they are absolutely on the ball with an eye out on the inflation target, but C, that market rates have already moved up quite a lot, and therefore they don't necessarily think that market rates need to move up, one for one, I think would be quite essential at this point in time.
Sure, Pradeep, just a quick last word. Didn't get any house targets from you either on the currency or on the 10-year. Do you have any that you can share?
I don't think we have a house target that I'm aware of on the 10-year. Currency house view is at 66, but I think it's a little bit dated. We are trading above that, and I personally don't think that we are going to see significant amount of rupee appreciation from here. So, that's where we are at this point.
Pradeep, thank you so much indeed for joining us. That's a view from HSBC on the currency markets.